There are several concepts to learn to apply solid position management for this strategy. In this lecture, we will start having a look at the first one, adding to a position. As you already know, every time we open a trade, we set two take profits, one at 1 ATR and one at 2 ATR. But what happens when the market doesn't immediately move our way? What happens if the price, instead of going towards our take profits, goes the opposite way? In that case, we have a set of rules to manage our position. The first one we're going to see in this lecture is add more trades to a position. Before diving into these important rules, I want to briefly talk about the idea of adding to a losing position. In my career as a trader, and even more during my experience as an instructor and moderator of a Forex forum, I've seen countless aspiring traders blow up their entire accounts precisely because they kept adding to losing trades. It usually goes like this. You open a promising trade, but suddenly it moves against you and you start losing money. You quickly find yourself down 100 pips. At this moment, you are faced with a decision. Many traders think there's no way it will keep going down. I'll hold it a bit longer and add to my position at this better price so I can quickly recover. Maybe I'll break even and this bad trade won't cost me anything. But the price keeps dropping. Now it's 200 pips down and you're losing 10% of your account. Frustration grows and you think it's impossible that it falls further. This is my chance to add more lots at an even better price and hopefully I will recover soon. Yet the trade continues to go down, 300 pips now, and you're losing 25% of your account. Panic sets in and you start to think, this can't be real. How is this happening? The market must be rigged. I have no choice now. I'll risk all my remaining margin. It has to bounce back. And sadly, this story repeats every day, causing many traders to lose their entire accounts. The reality is, adding to a losing position can be extremely dangerous, unless you do it methodically, systematically, and based on clear criteria. I like to think of our position management like the bet size of blackjack players who count cards at the casino. Skilled blackjack players don't blindly increase their bets. They patiently observe the game, keep track of the cards that have already been dealt, and increase their bets only when they have a statistical advantage. When the odds shift slightly in their favor, let's say 51%, they start betting with a small size. If odds improve further, let's say to 52%, they increase their bets. When the advantage becomes clearer, let's say 55%, they bet significantly more. This is exactly the logic we follow with our strategy. We carefully add to our position as the odds shift increasingly in our favor, but always respecting clear, predefined rules that protect us from excessive risk. But you may wonder, why does the probability of success actually increase as a trade moves further against us? Imagine I offer you a brand new iPhone, the latest model, for $2,000. Would you buy it? Probably not, as it is too expensive. But what if I lower the price to $1,500? Perhaps more tempting, but maybe the answer will still be no, for a series of reasons. Maybe you don't like iPhone, or you don't want to spend $1,500 on a phone, or other reasons. So I lower the price further to $1,000. Still no, what if I say $500 or even $200? At some point, the price becomes irresistible, not just for you, but for many others. Demand increases because buyers recognize that buying the latest iPhone at $200 has excellent value. The Forex market behaves in a similar way. When the price declines significantly or rises significantly for a short position, More and more traders become attracted to the improved price. They can enter the market at a much better price compared to before. Demand increases, and this also increases the probability that the market will reverse. This is why the more the price moves against us, the more attractive and potentially profitable our position becomes. And that is why we add to it, but always following careful criteria that allow us to have risk under control. Now that we have clarified the logic behind that, let's have a look at the rules of position management. Our first rule concerns adding to a position, and it is quite simple. We open a new position every time the price moves 2 ATR against our initial entry. Let's walk through a practical example to make this clear. Suppose we enter a long position on Eurodollar at 1.1525. The ATR at this moment is exactly 10 pips. Following our strategy, we've opened 0.02 lots, splitting the position into two smaller trades of 0.01 lot each. The first take profit is at 1.1535, so 1 ATR from the entry. The second take profit is at 1.1545, so 2 ATR from the entry. But instead of going up towards our take profits, the price moves down. At 2 ATR from the entry, so at 1.1505, we open a new position with the same lot sizing of 0.02 lots that we're going to split into two trays of 0.01 lot each. If the market continues to move further down to 1.1485, so another 2 ATR below, we add another position, again with the same position sizing of 0.02 lots split into two trades of 0.01 lots, following exactly the same procedure. And we keep adding to our position like this, with the same lot sizing every time the price moves additional 2 ATR away from our entry. Let's take a trade together to see how we handle this rule of position management. We have a potential trade here on US dollar Japanese yen. Right now on this candlestick, the RSI is below 25. We just need to wait a few seconds to see if it closes like this, so that we can open a long position on US dollar Japanese yen for 0.02 lots, which we're going to split into two trades of 0.01 lot each. Okay, the candlestick has closed, the RSI is still below 25. Let's open our position on the MetaTrader 4. We've got almost the same price, just 2 fractional pips of difference between the two trades. I'm going to take the best price as a reference, so 146.37, since this is a long position. The first thing to do is to set the take profits. To do so, we need to check the value of the ATR on TradingView. It is exactly 16 pips, so we can go back to our MetaTrader 4 to set up our take profits. Again, I will use 146.37 as a reference. I open the calculator. You can also use the take profits calculator provided earlier. So we have 146.37 plus 16 pips, and we have 146.53, which we're going to set as our first take profit. We need to add another ATR, so another 16 pips to have the second take profit, which is 146.69 that we're going to insert in here. I think that by now you are familiar with this process of opening the position and setting the take profits. Now, what if the price moves against us instead of heading towards the take profits? In that case, we want to increase our position. We want to add to our position. How? We want to add a new position with the same lot size every time the price moves 2 ATR away from our entry. The ATR value is 16 pips, so 2 ATR is 32 pips. Every time the price moves 32 pips down from our entry, we add a new position of the same lot size as the original one, so 0.02 lots split into two trays of 0.01 lot each. I'm going to do it with a simple calculator to show you how it works, but later in this section I'll share a file that does it for you in an easy and fast way, so you will know exactly where to place take profits and where to add to the position. So we have 146.37 minus 32 pips, which represents 2 ATR, and we have a 146.05. This is the price at which we should increase our position. We should add another position of the same lot size as the original position. Now, do we stay at the computer waiting for that to happen? Of course not. We can set limit orders so that our trading is as automated as possible, requiring us to spend minimal time at the computer. Let me set the trades quickly. And here we have them. Of course, we can set up as many positions as we can like this, so we are prepared in case the market goes against us. I like to set 2 or 3 positions in advance, so I'm covered even in case of a big sudden movement of the market. Let's calculate at what level of price we should add again to our position. So 146.05 minus 2 ATR, so minus 32 pips, and we have 145.73. So I can set my new limit orders at this price. Again, after clarifying all the other rules of position management, I will share a file with you that will help you setting up your limit orders quickly and in an easy way. One last practical tip I want to share with you is that sometimes when the price moves against your trades, you will have many trades open on the market and you need a way to organize them to avoid to get confused. The best way to do it is to order the trades by price, either from the best price to the worst or from the worst price to the best. It's up to your personal preference. In order to do so, you will need to click on the price column where your entry prices are, and the MetaTrader 4 will automatically order them by price, making your terminal much more organized, as something that you will really need for when you have many trades open. Now, one thing you may wonder is, what about the take profits? How do we organize them when we have more than one position? This is exactly what we are going to learn in the next lecture.